Hi, I'm Jonathan Treussard, and welcome to Treussard Talks, where we talk about the mechanics of investing, the psychology of investing, and what it means to manage your wealth with purpose. Because understanding your wealth shouldn't be as complex as building it. Welcome to today's show. Mike Green, it's an honor to have you on Treussard Talks today. This is probably the last conversation I'll be recording in 2025. We're on the cusp of tipping into 2026. For better or worse, tell us your story. How did you get here?
Well, I clicked on a link and I came into the room. I assume what you mean is the career. I was very fortunate to attend the University of Pennsylvania's Wharton School of Business in the late 1980s, early 1990s. Fell in love with finance as a both theoretical construct and as a way of thinking about the world. That was actually after a very brief flirtation with going into physics and science. And so, I've always kind of brought the scientific method to the approach that I have in finance, asking kind of hard questions and not being afraid to say, why do people believe this sort of stuff? Rolled into strategic management consulting straight out of school, wanted to gain experience working directly with companies and understanding the operational side of the equation. Developed an expertise in valuing companies for strategic purposes similar to M&A, or really focused actually on corporate divestments. Codified a lot of those tools into a software package that ended up being bought by Credit Suisse in 1999. And then with that transition was when I made the shift over to active portfolio management. As you might expect, I did a survey of opportunities, and at that time recognized that small cap value was a heavily neglected space. We can actually talk about some of the mechanics that drove that in that time period that I did not diagnose at the time. I was approaching it very much from the kind of traditional, let's look at a discounted cash flow analysis, construct a weighted average cost of capital, et cetera. And it became clear that the sector was very, very cheap relative to other areas. Had a give or take 6-year career in small cap value management, first with a firm called Moody Aldrich Partners, then transitioning to Royce & Associates, which is the largest mutual fund manager of small caps.
So this is like the first half of the knots.
Yeah, this is the first half of the knots. And so I was very fortunate, like in all seriousness, luck always plays a role. Had I come in and decided to be a technology investor in 1999, I probably wouldn't be here today.
Well, I'm not sure the scientific method would have gotten you to that place, but sure.
Yeah, that's exactly. Well, that is the part that I will give myself a little bit of credit for, is recognizing that there was opportunity in small cap value that led to a positive career experience in the first 7 years of my career. In 2006, I actually recognized that small cap value had more than fully arbitraged. The valuation differentials had become significantly overvalued at that point. And, that's again where luck plays into the theme. One of my early clients of my software company, Mitch Julis at Canyon Partners, he and I ran into each other in New York City. He had repeatedly tried to get me to join Canyon Partners. They approached me again and said, look, we want to open a New York office. Is it us? Do you not want to work for Canyon Partners, or do you not want to be in Los Angeles? And I said, well, it's Los Angeles. I don't want to be in Los Angeles. So they gave me the opportunity to launch the Canyon Partners New York office, which over the next, give or take 8 years, I built from myself in a room to a team of about 25 people managing about $5 billion in assets. The total firm was about $15 billion at that time. And then in 2014, I had a similar opportunity where I was approached by Soros. They asked me to come to work for them. I said, no, I've got a great job. I don't need to do that. Scott Bessent, who was the CIO at Soros at that time, correctly intuited that was an opening by my specification of job and said, well, what if I funded a hedge fund for you, your own firm? That was very attractive to me. I have an entrepreneurial bent. Launched a firm called Ice Farm Capital, which I ran for a couple of years. Unfortunately, a series of legal issues put us on precarious footing. And when Scott Bessent resigned from Soros in 2015, Soros fired all the managers that he had brought in.
I remember that.
Yeah, I was part of what was called the Soros Massacre. That created conditions in which I shut that fund, took a year of sabbatical, and then went and managed Peter Thiel's personal capital in his platform called Thiel Macro. Did that for a little bit over 3 years.
But you stayed in New York through that, or you moved to the Bay Area?
No, I actually moved to California at that point, which was, I moved to Northern California, which was dramatically more attractive to me than Southern California. I actually was a California native. I grew up in the San Francisco area. And this was a chance to return home, spend time with my family, actually get my kids out of New York City as they were in their high school years. Candidly, we were pretty tired of raising kids in New York. We were in the center of the woke universe at that stage. Our kids schools were proving deeply unsatisfactory. And so it gave me an opportunity to put some changes in place. And during that sabbatical time period is when I started developing a lot of the theories around passive investing that you've heard me talk about, in his classic interview style is tell me the one thing that everybody else thinks is true that you think is not true, or the reverse that you think is true that everybody else thinks is not true. And my reaction to that is passive investing is actually not passive at all. It has distinct implications and impact on market structure that, the rest is history sort of thing. And so I worked for Peter for a number of years. We had some very successful trades, particularly around the XIV, the Volmageddon event.
For the people that weren't on the ground then, can you give us the 30-second version?
Sure. So once I had begun to do the work around how passive investing or index investing or systematic strategies were actually impacting markets, I did a survey of where we were seeing the greatest levels of penetration of these types of strategies, and also where trades could be expressed to take advantage of this. We recognize that the inverse VIX complex, XIV, SVXY, et cetera, which had become extremely popular trades at that time period. There were actually articles being written in the Wall Street Journal about former Target store managers becoming fund managers, raising $100 million funds around this.
Just basically short volatility.
Which is a short volatility expression, which is a phenomenal way of expressing a levered bet on things being basically the same, right?
It's a wonderful way to make money in a peaceful environment.
It's a wonderful way to make money in a peaceful environment. And the systematic strategies around that, just continually shorting volatility, on average, is usually about a 4 times levered exposure to the S&P, about 4.5 actually. But people were looking at this as if it was a largely risk-free trade. It had become about 70% of the daily trading volume in the UX futures, which is actually the product that represents a forward pricing attempt for the pricing of the strip of S&P options, had become incredibly systematic to the point that basically all of the liquidity was being consumed by these systematic index strategies. And it became very predictable that on something that caused an elevated increase in that volume, that the liquidity in the product would be overwhelmed and there was the possibility of an immediate crash to zero. The actual mathematics behind that are very straightforward. The XIV is inverse to the VIX, which a lot of people talk about as the fear index. I don't think that's quite right, but it's a reasonable approximation for it. When you have an inverse product, to get something to go to zero just requires a 100% increase. And so by definition, as the VIX got lower and lower and the implied volatility got lower and lower, the probability of an event where a point change was enough to create a collapse to zero became higher and higher and higher. And so perversely, the distribution of outcomes, usually you think about a stock going up in price, it reflects it becoming less risky. The XIV had a bimodal distribution as compared to a normal distribution. The probability of it going to zero was getting higher and higher and higher to the point that we actually did the calculation. There was roughly a 95% chance that it was going to go to zero over the next 2 years.
And to just give some numbers for people trying to follow, if you think about volatility VIX as an example, right? And you think that normal, peaceful, whatever that is some version of 20, I'll just call it. And at the top of the distribution would be something like the financial crisis where, VIX was flirting with 80 for just simplicity, which is very high relative to 20, right? But when you got to 80, the odds you were going to 160 were significantly smaller than when you're kind of like hanging around at 12 and you're staring at the odds of going to 24.
Right. And I would go a step further. The VIX actually was regularly printing in 2017 well into single digits. So it was printing in the 7, 8, 9 range. Normal volatility, to your point, is itself a bimodal distribution. During recessionary periods, it tends to hover around 22. During normal expansionary periods, it tends to hover around 12. And so 7, 8, 9 is incredibly low, not quite 6, 7, as you might say.
I have teen daughters. I can't do this, Mike.
I saw your reaction there. But, to get a point jump from 9 to 18 is actually not hard at all. And that was really what underpinned it. As it came inside that 2-year window, there are products called leap puts. They lock in a 2-year time horizon. We were able to secure those leap puts for about $250 million worth of exposure that would pay out in the event the product crashed as we anticipated it might. And I gave a presentation on this in May of 2017 at the EQD Derivatives Conference in Las Vegas. Part of the reason that the trade became well known is, unbeknownst to me, in the audience was the founder of the XIV product. He and I had a big short type discussion in which I had outlined my perspective that this product represented significant risk. He proceeded to try to explain that I didn't understand it. He projected it would survive a crash of 1987 event. My argument was that it would go to zero on a 4% decline, one-day decline in the S&P. And it went to zero in February of 2018 on a 3.9% decline in the S&P 500, from which you can either take the conclusion that I'm way too conservative in my forecasts or that I was right in my analysis. And so it ended up paying out very well for us. In 2020, I left Teal, basically took a little bit of time, explored launching another hedge fund. And then ultimately the rule changes in September of 2020, what's called the derivative rule, facilitated the inclusion of the types of strategies that I've historically managed in hedge funds into ETFs. We launched Simplify. It was actually launched by Paul Kim and Dave Burns in September of 2020. I joined in February of 2021. And today we're about $12 billion in assets spread across 30 different strategies. I'm the chief strategist of the firm. I directly manage our high yield product, which is about a $500 million fund. And that's kind of how I got here.
Yeah. And again, speaks to the fact that the environment matters, right? And the types of things that were not available in ETF land until recently are now available. And I would argue some of it is for the better, and some of it we'll find out how that plays out, because not everybody has the background to understand some of the mechanics that are playing into some of these.
I think that's absolutely correct. I also think it's really important, particularly when you think about things like short volatility strategies, et cetera, exactly like the XIV. They are phenomenal strategies as long as the world basically exists as it did yesterday. A lot of the areas that people worry about, things like zero data expiry options, et cetera, you've heard me be relatively sanguine on. If you go back and you look at the dynamics around the global financial crisis, the crash in 2007, 2008, what was unique about that time period is a lot of the speculative structures that were emerging were very long dated in their construction. Things like 10-year variance contracts, for example. That was the very famous Warren Buffett trades in 2006, 2007 that caused all sorts of concern coming into the fourth quarter of 2008. Today, most of the structures are actually what I would describe as compared to weapons of mass destruction. Most of them are actually built on very short time horizons. And so things like a 0-day or a 1-day expiry option, that's a little bit like playing Russian roulette, right? It's super dangerous, but it's really hard to cause systemic events around a single day event.
No, I think that's exactly right. And again, a 0-day option, and this may be a little bit of foreshadowing, that market has exploded. I mean, it makes up, I think, the majority of the volume at this point. And it has societal implications. I think of it as really fundamentally, one, driven by the desire of a class of investors to gamble because they feel like this might be their only shot at, fill in the blank, kind of escaping whatever state of the world they're experiencing. But fundamentally, on a daily basis, it probably is a pretty easy kind of wealth redistribution mechanism. But to your point, we can have opinions about that. While it may have societal implications, it probably doesn't have systematic financial markets implications, as opposed to, as you said, some of the longer dated strategies that, of course, have different risk characteristics. And again, it's easy to go from rich one day to done the next. You talked a lot about your professional path. I want to acknowledge one of the things I love about you is your writing. And of course, there is your Substack. Yes, I gave the fig. But of course, there's also your, I'm not sure we call it Twitter or X at this point. I'm not sure how
I
active
call it
you
Twitter,
are.
but yeah.
Your handle is cool, Prof Plum 99. But what's really cool about it is that little picture, which is not a picture of you, but instead is a picture of Wally Shawn playing Vizzini in Princess Bride. Do I have that right?
Yes, you do have that right.
you may submit that it's just clever, but actually there's something really deep to that. If you remember that famous scene where Vizzini and the man in black are having a battle of wits over the poison wine, Vizzini says, well, a clever man would put the poison into his own goblet because he would know that only a great fool would reach for the one he was given. But I'm not a great fool. I will clearly not choose the one in front of me, and so on and so forth. And the point, of course, is Vizzini is so clever that he outthinks himself and lands on the wrong goblet. In the meantime, the man in black has done kind of the serious work, if you will. And to me, that's how I think about you, which is when you think about markets, when you think about investing, when you think about societal issues, you fundamentally have a choice between being clever and being serious. And it strikes me, one of the things I respect about you is you've chosen the latter path.
I have to tell you, you are the first person who has ever independently derived exactly why I chose that character. I know I'm a really smart guy. I'm not the smartest man in the world, as Vizzini pretends to be in The Princess Bride. But what I also know about myself is that where they trip themselves up is where they think they know the game, but they don't actually understand the rules. And so Vizzini got himself twisted in knots thinking about how do I analyze the situation from the perspective of which cup the poison is in. He never considered the alternative scenario that his opponent had built up immunity to iocane powder and therefore put the poison in both cups. Right. And that's where people tend to get killed in markets, is where they enter into a form of analysis paralysis where they don't actually know the rules of the game. And so my serious study has always been about what are the actual rules of the game? What is the system that I am playing in? Trying to make sure that I survive to the next round, which is one of the reasons why, many of my peers think of me as a cockroach. They just can't get rid of me. But, the simple reality is that if you know the rules of the game, one, you're less likely to commit a fatal blunder. And two, you position yourself to actually take advantage of opportunities when they emerge. And it's not enough to be clever. You have to actually truly understand the rules.
I think that's right. And again, obviously there's the famous saying, it ain't what you don't know that kills you. It's what you think you know that ain't so. I guess that's Mark Twain, right? And in a slightly more educated version of that is what Bob Merton always said to his class when I was attending his class and then when I worked with him, which is, there's only one thing that's worse than not having insurance is to think you do when you don't. And the point is, when you think you're playing a particular game and you're actually playing a different game, you're exposed to a different set of risks. That's when things go, sideways. Look, I'll take the honor of figuring out why Vizzini. That means a lot to me. Maybe I'm clever, as it turns out.
I think you're thorough, but yeah.
But I do think there is, when we talk about seriousness versus being clever, I think part of it is moral responsibility and speaking truth as you see it. And so now I want to talk about the thing that you've been known about for a period of time, which is passive investing and your critique of it. Mm-hmm. And the reason it's serious is because it has societal implications. It's one of those things that feels like a fabulous answer to a massive problem until you kind of tease out the second and third order implications. So you want to take us through the aha moment and what's the structural impact in your view of passive investing, particularly in U.S. equity markets today?
Yeah, so in U.S. equity markets is really the primary place that this has reached its greatest expression. We now have more than 50% of aggregate market cap in the U.S. equity markets in passive investment strategies. The theory behind passive investment was ultimately created in the late 1960s, early 1970s as a byproduct of the efficient market hypothesis. The observation being simply that if prices are ultimately set by people competing to express information into individual security prices, instead of spending the costly effort to obtain that information, you could simply accept everybody else's work and own securities in proportion to their expressed market capitalization. That would be the lowest cost, most efficient expression of the market. The theoretical frameworks for why this worked and ultimately led to outperformance were laid out in a 1991 paper by Bill Sharp called The Arithmetic of Active Management, in which he observed that under a theoretical framework, the passive holders owned in aggregate the same securities as all of the active holders. Therefore, the performance on a pre-fee basis for the two aggregate portfolios would have to be the same, since passive strategies didn't incur the costly information gathering and analysis they were able to charge lower fees. Therefore, the investor in a passive strategy would be better off by difference of the fee differential.
Yeah.
And that was the theory that was put forward in 1991. There were a number of assumptions around it. And candidly, I didn't spend that much time thinking about it or challenging it until 2016, when I had that period of time off. By the way, it's one of the things that I can't emphasize enough, how important it is for people to take time off with no risk on the table. Because when we're doing our jobs on a day-to-day basis, I have to be incredibly aware of a million different variables. What's happening with credit spreads, what's happening with individual securities, what's happening in terms of the macroeconomic frameworks, et cetera. The minute you take that risk off, you suddenly discover that your cognitive load collapses and you can think about things in a much more holistic fashion. I was very fortunate that during that time period, a brilliant partner at AQR, Lasse Peterson, came out with a paper called Sharpening the Arithmetic of Active Management that challenged, and this was really the first fulsome challenge to Sharpe's analysis, in which Lasse highlighted that footnote number 4 in that paper, which outlines some of the assumptions, included the observation that the definition of a passive investor is somebody who never transacts, and that therefore a active investor is simply one who is not passive, meaning anyone who ever transacts has to be active by definition. Lasse observed that during periods of index reconstitution, we change the components in the S&P 500, or on a regular basis, every 6 months, we change the composition of the Russell indices. That creates a change in the underlying portfolio that forces transactions onto passive players. They cease being passive players and become active players for a period of time. And during that window of opportunity, the active managers can apply superior information to begin to outperform. It's no longer simply a difference of fees. And this is actually incredibly important work. Among other things, it predicted the rise of the single largest hedge fund strategy today, which is equity index arbitrage, basically trying to predict what stocks are going in the S&P 500 or migrating across the various Russell indices, et cetera. It's by far the largest individual strategy at the equity hedge fund level.
And Mike, before, just to put a finer point on this, the trading that happens within passive funds, and this is where it becomes a bit of a Rorschach type of thing, where it's like, what is this about? One argument is, well, there are mindless passive rebalancers out there, and they're going to get through the chainsaw of what the smarter hedge fund people are doing, kind of front running them for better or worse. There is another argument, which honestly has a huge amount of validity, which is, hey, we're in the liquidity provision business when the other side desperately needs liquidity because their valuation indifferent. They just need to hit their points.
Yeah, I think that's exactly right. And so, one of the things that jumps out of starting to think about it in these terms, where Lasse identified that the portfolio change at the index level created transactions, my observation was, wait a second, there's actually a second point at which the portfolio changes, which is any time an end investor contributes cash or takes cash away from the fund itself. That also forces trading activity. And the minute you recognize that, then you recognize there is never a period in which these vehicles are actually passive investors. By Sharpe's own definition, they remain continuously active. And as a result, it's improper to label them passive. What they actually are systematic algorithmic investors. And we know that systematic algorithmic strategies become crowded. We know the tools and techniques for analyzing that. And largely, that's what I began to do. And so my work around passive really grew out of the observation from Lasse Peterson that on index reconstitution, they were forced to trade. I took it a step further and said, wait a second, when cash is added or taken away, they also are forced to trade. That means we can use alternate approaches to identify this. I initially began sharing my work once I recognized this, and once I had the initial success with the XIV, I primarily targeted regulators. I really wanted to try to get this system changed and make people aware that the continuous flow into passive vehicles created systemic issues. The natural audience for that is regulators. Unfortunately, what I discovered in that process is that regulators, while they agreed with my math, were ultimately powerless because of the regulatory capture that had occurred from the largest fund institutions like Vanguard and BlackRock. And as a result, nothing was going to change. That's a very frustrating thing to hear, but it also then forces a series of alternate choices on you, including starting to raise public awareness on this and speak the truth about what's really going on. And for the last decade or so, that has been a big part of my journey.
Yeah. And just to be clear, there is a kernel of truth in the basic premise, right? The issue isn't the basic premise. The issue are the unintended consequences and the second order implications. When you give someone whose job it is not the opportunity to have opinions about stocks and things, they'll say things, well, I like. And I like is not exactly a scientific method for analyzing securities. And so the appeal is, well, passive kind of removes the I like and says, hey, how about you free ride on the work of serious professionals? Cool, I get to do that. That's kind of amazing. The issue, of course, is free riding cannot be done at a scale of 100, because if we all free ride, well, there's nobody else on the other side. That's number one. The other part of it, and that's the second order implications, is cash is hitting these funds every 2 weeks. Of course, what you're talking about are things like 401k contributions. So every time you go to paycheck, you're actually buying more securities in the same proportions as where the quote unquote market was last week. And you're doing it in a systematic, valuation insensitive manner. So there's kind of this self-reinforcing mechanism.
I think that's a very good description of it. I might even take it a little bit further and simply say that part of my initial work into this was exactly on this topic of, can we help understand how passive influences markets at different levels? John Bogle very famously said, if everybody indexed, it would be chaos, catastrophe, the markets would fail. He said that in May of 2017, ironically, 8 months before my trades on the XIV. The problem is that he had done the analysis, or really when he actually hadn't really done the analysis, it was largely a thought experiment tied to what's called the Grossman-Stiglitz paradox, which exactly as you said, if everybody's free riding, we have no idea what actually happens because it's a little bit like a singularity.
And by the way, the Grossman-Stiglitz paradox gets you to a no trade outcome, right? Where we're all kind of frozen in time because we have no information.
Yes, that's correct. If you get to that point, well, it actually goes in both directions, right? But it introduces an interesting dichotomy, which is we are supposed to trade because of changing information in aggregate. But the reality is, and this kind of introduces the work of Ole Peters, a mathematician in London, around ergodicity, the market is actually composed of individuals who don't necessarily trade because of information that's tied to the underlying securities. They'll trade tied to life events, right? I need a new car. I need to buy a house. I'm going to retire and I need to start taking distributions. None of those carries any information about NVIDIA. It's actually an expression of your individual circumstances. And so even in a Grossman-Stiglitz type framework, what you actually end up with is basically prices vacillating between 0 and infinity on a continuous basis, because you need to clear trades in the absence of anyone who's actually standing on the other side of a trade. It becomes a true singularity. We actually don't know what happens. We just know that volatility explodes. A lot of my work actually helped to explain that very low volatility environment that we had in 2016, 2017. There were a number of reasons why that occurred, but one of them is there's actually a benefit associated with the growth of passive as a systematic algorithmic strategy. Initially, it introduces heterogeneity into the behavior of investors. It facilitates liquidity. If I want to go to sell, and I may be selling because of valuation reasons, or I may be selling because I've identified an anomaly in the markets, and I want to express a point of view. If there's somebody on the other side whose job is simply, if you give me cash, then buy, that facilitates liquidity and actually lowers volatility. It reduces the observed levels of volatility. My work suggested that around 25% passive was the maximum size that you would get to before you actually became vol enhancing. And if we go back to 2016, 2017, we were about 30% passive by market capitalization at that point. We were very near that sweet spot in which it was almost inevitable that the underlying volatility was starting to rise. I wish I could claim perfect credit for why the volatility explosion happened on February 5th, 2018, it actually turns out that there were regulatory changes that were instituted on February 2nd, 2018, that forced many players in the short volatility space to transact. And that was the proximate catalyst that caused it to occur. But the environment was already primed for that type of event.
Thanks for listening. I'm Jonathan Treussard, founder of Treussard Capital Management. I hope you're enjoying this episode. If you'd like to start receiving my free newsletter, Wealth Empowered, or if you'd like to learn more about me and Treussard Capital Management, go to Treussard.com. That's TREUSSARD.com. Thanks, and enjoy the rest of the episode.
Right. And so, to your point, when you talk about life events, whether it's retiring or buying a car or whatever, the term in the economic textbook for that would be a noise trader, someone who's trading not because of anything that has anything to do with the markets. And so in a lot of ways, yeah, we have more noise traders, wonderful, whose job is fundamentally to catch the market, to provide liquidity, which is great, I suppose, until it isn't, along a couple of dimensions. One, again, if you overwhelm the system with a set of buyers, to the extent that a lot of that has to do with 401k contributions, I would just call it a time of prosperity. We end up with what I would argue is probably where we are today, which is a significant premium of U.S. equities to the rest of the world, because the rest of the world doesn't have the same kind of clever mechanism for buying upon buying upon buying. The other part of it is that class of investors probably isn't noise traders anymore, in that there is an underlying correlation, which is whether they all start retiring at the same time, or if they all stop making contributions at the same time because we hit a recession, then things can go badly pretty quickly. Is that the natural next increment of thought?
Yeah, so that is absolutely the next increment of thought. I would propose maybe an interim point, though, which is John Bogle and others famously have identified areas like 75% or 85% passive as the point at which this really begins to affect markets and break. The problem with that analysis, what I've seen on it, Andrew Lowe had similar calculations. Those were run against static levels, right? So if I run the analysis at 25% passive or 30% passive or 50% passive or 70% passive, and I build an agent-based model and I allow them to trade, and a passive vehicle is simply a systematic algorithmic strategy that responds to a request for cash by selling and a request to buy by buying, right? Or an influx of cash by buying. We get actually very predictable behavior where the natural volatility begins to explode around that 75 to 85% level, and things very quickly get out of control and the market can no longer sustain itself. We kind of broadly accept that. What that failed to consider, and this is again where background in physics becomes helpful, is the required change in the population behavior to get there. So you don't just like wake up at 85% passive or 75% passive. The process of getting there requires periods of time where the net contributions to the market, the incremental behavior, is close to 100% passive for you to get eventually to a 75 or 85% passive. That's what really shifted around 2014, 2015. We changed some of the rules around how people invest their 401ks. In particular, in 2006, with the Pension Protection Act, we changed the process of participation in 401ks from an opt-in framework where you had to choose to participate, and then you as an individual had to select the vehicles that you were going to invest in, to an opt-out framework in which you were automatically defaulted in. This was part of George Bush's, the ownership society type framework. Overall, a good thing. We want people to feel like owners in society. We want them to feel vested, et cetera. But that transition, if you're going to default people into the market, requires you to select for them in advance what they're going to invest in.
And therefore, you need a safe harbor because you don't want to be getting sued.
Correct. And so the Pension Protection Act created something called the Qualified Default Investment Alternative. And that, more than anything else, changed the face of the industry. It was perfectly well-intentioned, disastrous policy that basically selected passive investment vehicles and said, this is the safe way for the vast majority of participants to participate. What that meant was the new participants in the system defaulted into passive because they were unlikely to change their selection criteria because they didn't have any real insight in terms of what they were investing in. That meant that basically 100% of the new inflows were coming in. It was really about 95% of the inflows that were coming in. As we began to hit the period of 2013, 2014, we hit the demographic cliff of the early baby boomers beginning to retire because they had not been participants in this system. They owned active managers, the traditional vehicles, and they began to redeem from those active managers to fund their retirements and their rotations, while the new money coming in became passive. And at that point, a very interesting phenomenon occurred. We effectively began to have outflows from active managers while inflows to passive managers accelerated. That meant more than 100% of the marginal capital that was coming into the market was passive in its construction. And if you think about it again in a physics term, right, what's called a loading factor, that meant that we were now negatively loading the traditional securities selection process because we're firing the active managers who would have chosen to select on a fundamental or valuation type basis. A little bit skewed in the term, but we were putting money into passive strategies that effectively reward size and momentum. And basically from that point, I mean, Jonathan, I saw this analysis the other day. It was presented, the traditional box charts that show like what's been the best performing strategy over the past year. And it has kind of like the last decade to show you the variety of different options that have outperformed. Literally over the last 9 years, 8 of the 9 years, large cap momentum has been the best performing strategy. Exactly as you would expect. Small cap value has been among the worst performing strategies because it has total negative loading against those factors. And so we've actually seen this play through mechanically in markets over the last decade, which I have a propensity to get into arguments with people about this stuff. I'm very confident in my analysis when I've done a good job of it. And so I'm willing to stand my ground on these things. But literally for the last decade, I've been arguing with people, no, I understand you think small cap value is cheap. It can't work. I know you think that emerging markets are cheap. It can't work. And these are the mechanical reasons why. And that's, interestingly enough, simultaneously led to me getting a sobriquet of being an irrational, crazy bull on one side and an irrational, crazy bear on the other side.
Yeah, I mean, you should be able to walk and chew gum. There's no question. And then the other part of it, again, is very simple, which is people say, well, don't fight the Fed. How about trying to fight a tsunami of money? You want to be that guy on the rowboat? And yet, the issue, again, is one could envision a world in which that feedback loop, basically, to just call it what it is, which is large cap US stocks, something could break it. But there's a reasonable argument, which is when the money stops coming in, which is a recession.
Well, it actually has the seeds of its own destruction. I mean, this is an important thing for people to understand. Withdrawals will always be a function of asset values. I will withdraw 4% of my wealth to meet my spending objectives, right? That's actually encoded within 401ks in the form of what are called required minimum distributions. Those accelerate over time as you age to the point that once you're about 95 or so, I believe it's something like 16% has to be sold every year. And the second part of that is contributions are always going to be a function of income. I can only save out of my income. I can't save out of wealth, right? And so contributions are always going to be a function of income. Withdrawals are always going to be a function of asset levels. That's why something like the Buffett indicator has historically worked, because what you're actually doing is measuring those two components: wealth, stock market capitalization, income, GDP, right? The stock market to GDP ratio is simply telling you the ratio of wealth to income. Now, one of the more interesting features of this is, again, to reintroduce that physics term, loading. We know that if water gets hot enough, it will eventually start to boil. It'll turn into water vapor. That process of conversion of state lowers the temperature of the water itself, keeps it from moving above 212 degrees Fahrenheit or 100 degrees Celsius. And the steam itself can become superheated, but it tends to release itself. All else equal, that would cause the water to cool, i.e. a bear market. We've effectively put a stove underneath this because of the flow of passive funds. And so the temperature can continue to rise. The water can continue to get hotter. If we put a lid on it, it'll blow up in a classic pressure boiler type framework. These are all factors that we're now actually seeing playing out in markets. Valuations are being driven to levels that we could never have imagined before. And we go back and we look at 2000, how crazy we thought that was. This is crazier.
Yeah.
Right? This is totally crazier.
And this might provide us a pathway to a bridge. It leads to the societal point, which is we might have painted ourselves into a corner where we basically can't afford for this thing to blow up. And we will likely do everything in our power as a system, as a society, to avoid it. And my suspicion is it means in a weird way, and tell me if that doesn't ring true to you, that basically we can't afford things like unemployment spikes anymore. And not because we care about labor. I wish we did, because we cared about people having fulfilling jobs and going to work in the morning and not staying home and drinking. I mean, whatever the thing is, right? Not because of that, because we actually are trying to protect capital. We're trying to protect this edifice. But of course, I'm not sure that's a thing you can actually achieve.
This is hitting on a point that I try to make, and I use the expression, we're asking the markets to do too much. Financial markets are not actually about providing retirement vehicles. They are about pricing the marginal cost of capital for equity or fixed income and using the wisdom of the crowds to arrive at those designations. With the Pension Protection Act in 2006, much like we did with the mortgage market in earlier time periods, starting in the 1990s and then expanding in that time period, when you declare that the objective of housing is for people to own housing as compared to have housing, to be housed, that's going to change the behaviors of the market. When we changed markets from pricing the marginal cost of capital for corporate finance choices to providing a retirement utility, it absolutely did exactly what you described. It forced policymakers to become reactive and try to prevent the events that could cause prices to decline, particularly decline precipitously, for the very simple reason that you cannot have retirement systems fail. Markets can crash, but retirement systems can't fail because that dramatically undermines the economic activity on which we all depend.
Yeah. The ownership society was such a well-intended and yet perverse, again, I have so much empathy for it. I think it feels right, but the unintended consequences are huge. And we had obviously the global financial crisis when it came to housing. And I think part of it too is and this is what concerns me about our social compact. You keep telling people, trust us, do this thing, whatever the thing is. And then every time around, not out of malevolence necessarily, but out of a lack of understanding of second order implications, the thing that you tell people to quote unquote trust you and do comes back to bite them in the butt. And so no wonder they're not happy. I think that's a huge part of it. Look, I know the last month has probably been one of the most exhausting and possibly bruising months of your life. I suspect it might have been.
I'm only 23 years old. Can you believe it?
That's right.
I've aged so much.
And one of the reasons it's been exhausting and bruising, and again, I hope to some degree exhilarating as well, because I don't think you stepped into this out of nowhere, is you've been writing about kind of what it looks like today to be working class in America, the nature of poverty, and in your latest piece, this broader concept that we've probably been transitioning in a way from and I hope I'm using the right term, but I really liked it, this from a striving society, a society that rewards and glorifies and empowers strivers, to more of a rentier society, people that are collecting rent. And I understand that putting these thoughts out into the public domain is probably natural to you, but it has come at a cost. I just want to tell you why it resonated with me as much as it has. I was a student of Earl Thompson at UCLA, and Earl Thompson honestly taught me, this was in my undergrad years as the tech bubble was bursting, and Earl taught me probably as much about economic theory as anybody else, but he also taught me the importance of quote unquote not trusting the intellectual cartel. And I'm taking this from the preface to his book because I hope it resonates with you and it'll set the stage for what I think you're contending with. He said, one of us, this was a book he co-authored with Charlie Hickson, one of us started his professional life as a libertarian, the other as a Marxist. Soon thereafter, serious economic research taught us that practical solutions to real-world problems did not emerge from the engaging ideologies taught to us by activist economics teachers. Realistic transaction and protection costs negated the libertarian conclusions of classical economists, and competition, whether economic or political, possessed none of the devastating inconsistencies charged to it by Marx. He then wrote about the established economic profession. And to him, these were economic professors. I think today it equally applies to think tanks that have neatly divided themselves across political lines. These thinkers have been organized into coordinated intellectual cliques whose material welfare, their livelihood, is founded upon their ability to provide a long series of moderately useful, hopefully demand-creating solutions. And then he closed, "We would like to be popular. It's just that we have found the truth, or at least a continuously logical and empirically disciplined approach to finding it. Too socially important to make the appropriate sacrifices. Having just shot a round of buckshot in a room full of well-protected kings, we had better produce one hell of a good explanation." I think you just did that. I think you just shot a round of buckshot in a room of well-protected kings. So tell me about the last month.
Okay, well, first of all, as quick background, since 2006, I actually have continuously written on a weekly basis to summarize for my investors kind of what I'm thinking about, how I see things in the world working, et cetera. During the time that I ran Ice Farm, it became a very popular and widely distributed letter in the vein of many other letters that are put out there. It was coming from my perspective as a global macro hedge fund manager, well received. And I continued that process largely continuously up until Simplify, when I launched, and Substack actually allowed me to transition that into a vehicle that became more broadly available as compared to a closed form email that was sent only to accredited investors. That Substack, Yes, I Give a Fig, is really just kind of like, some people have described it as like Mike Green's attic, right? It's the place where like his random thoughts and things are coming through and he's trying to formulate his views on stuff, et cetera. About a month ago, I had an experience in which I saw a presentation of an idea on Twitter from a right-wing influencer that was lamenting the idea in 1950, a single income earner could afford this. And it was a picture of a house. And candidly, it was too nice of a house. It was historically inaccurate. But in response to that, there was this incredibly coordinated mocking campaign, very similar to your observations from the professor of there's a coordinated behavioral component or response to this that literally just turned it into this giant mocking campaign where, thousands and thousands of replies made fun of this and said something like, in 1962, a janitor could afford this, and it's a castle in Austria sort of thing, or a peanut farmer could afford this house, and it was the White House. And of course, I joked that actually did occur in the 1970s, but regardless, it was designed to effectively take a meaningful lament and concern, the affordability dynamics of forming a household and conducting life in a traditional nuclear family framework in which one person's work and effort is allocated towards child rearing, and another person's work and effort is allocated to obtaining market resources that we call paychecks, and turn it into this, just like, how could you be so stupid sort of thing, right? And that piece I wrote was called, Are You an American? It was addressing a piece that was identified by somebody responding to this, where they continued the mocking process, but they asserted that if you simply lowered your expectations closer to those from the 1950s or 1960s, that you could very easily still afford this. And I did this analysis for the town that this individual had identified, Caldwell, New Jersey, and I came away saying, no, they're totally wrong. You can't afford this. This is not actually on your agenda if you're anywhere close to a quote unquote normal person.
Not on the menu, even if you turn off TikTok and the kind of FOMO machine.
Yeah, I mean, you would need to be in the top 10% of the population in order to afford living in Caldwell, New Jersey, which this individual mistakenly presented as easily achievable. That kind of started me down this path of saying, all right, what's really going on? And when I was doing research on this, I stumbled across what the poverty line actually is. I described it in my piece. The poverty line actually was created in 1963 by a Department of Health and Human Services economist, Molly Orshansky, who identified that the typical family budget was roughly 3 times the amount of money that they spent on food. 3 times the amount of food would cover all your housing. It would cover your childcare. It would cover your educational expenses. It would cover some vacation time, et cetera, your transportation costs.
Healthcare.
Your healthcare, et cetera, right? And so what she recognized was that this actually made it relatively easy. We didn't really have tools that made it super easy to track all those other expenses. But by simply arriving at a level where they took the USDA minimum food budget and tripled it, they could identify a family that was clearly incapable of meeting its needs, a point of crisis. They adopted that officially in 1969, even though by then the data had begun to diverge meaningfully. It was politically expedient to adopt it. And from that point, they inflated it by the CPI. And as I described it at that point, when I read this, I felt sick because it actually explained so much of what was really going on. That food budget in 1963 or 1969, representing 1/3 of household expenditures, has changed radically. That same food budget today would be between 5 and 7% of the typical household expenditures. And so what we had actually done was basically take a small fraction of today's budget. We had inflated it at the CPI, which, to be fair to many critics that emerged, the CPI itself overstates the aggregate inflation experience because it doesn't fully capture things like substitution, new innovations, et cetera. But it attempts to do so. And perversely, that actually means that it significantly overstates inflation that is experienced by those who have tons of choices and seek diversity in their consumption baskets. And it radically understates inflation for those who are trapped in a fixed basket, effectively picking up the bottom of the barrel.
Yeah.
And so once that was identified, it turned into a much wider analysis of, okay, what does this budget actually look like? And the analysis for Caldwell, New Jersey, was that what had been the inflation-adjusted equivalent of $32,000 for a family of 4 with 2 income earners and 2 children, instead of $32,000, that number is about $140,000, $136,500 to be precise. And so that's what I wrote. And I wrote about my process of discovery and what that meant in terms of the implications for it. And in particular, I identified where the poverty line really matters in national policy discussions is in the withdrawal of benefits. So once you begin exceeding the poverty line, the government, which is providing benefits to you up to that point, starts taking them away. If you make over $40,000 a year as that family, you start to lose benefits like food stamps and SNAP.
It creates all these cliff outcomes.
Right. And so those benefit cliffs means that resources that are provided to you on an after-tax basis, a government voucher for food, you're not taxed for that. It's basically after-tax dollars, suddenly not only are taken away, but then have to be paid with after-tax dollars. It literally creates these benefit cliffs that I described as the valley of death, this experience that you go into this regime in which you're ostensibly doing better, but at every step in the process, it's actually getting harder.
Yeah.
And that somewhat vivid language, I think, really captured the attention of people. The post ended up going viral, right? One of the things that I've been accused of is picking that $140,000 level to cause it to go viral. One of the things I'd point out is another institution, smartasset.com, wrote a piece this past summer at which they identified that level at $250,000, right? That didn't go viral. It wasn't because of the level that it went viral. It was because of the accuracy of the presentation of what people were actually experiencing that suddenly allowed people to say, oh my gosh, that's what's happening to me, right? And they began forwarding it around. That was then picked up by people who wanted to engage in the same type of mockery of my analysis that they did of the house component. The problem is that they then amplified it in the process of trying to make fun of it. And people literally turned around and were like, no, that's actually pretty right. Things like childcare. If you have a 2-income family and you have children, you no longer have a choice that they have to be taken care of at some point in the process, right? There is no informal network of teenage girls to watch the kids after school. There is no informal network of other stay-at-home moms who can swap off obligations, et cetera. All of that disappeared. And so you're forced into a market economy where childcare, due to licensing and insurance restrictions, is continuously underprovided, causing that price to rise at an accelerated rate. And it's shocking that the single largest budget item for families with young children is actually childcare.
And by the way, if you set aside all the political issues that came out of this, you hit a tripwire. Here is the basic version of the story as I read it literally that day when it came out. I love reading your stuff. And I was like, okay, what is this one? We hard coded a number. We happened to hard code a number of like 3x food because it was easy, expedient, so on and so forth. Anybody who's ever done anything with numbers and modeling knows that hard coding anything usually comes back to bite you. So that isn't shocking. And then you say, oh, let me explain to you how the hard-coded number kind of fell apart. Other things started eating into your family budget in a much bigger way than they had. The reason I think your post went viral isn't because of the kind of shock jock value, is because it is intuitively perceived to be correct on the basis of the hard work you did. You're like, dude, we all know that we've had, and again, you identify things like regulatory burden and insurance costs and so on and so forth in childcare provision. By the way, I think there are societal components to this. When I was a baby, when I was a kid, my family lived in the same town outside of Paris as my grandparents. My grandparents would watch me after school. Both of my parents worked. I live halfway around the world from my mother. My mother does not get to be a free provision of childcare to my children. The world has changed. To your point, the non-market economy has changed radically. It's declined. We now live in a much more transactional world than I think we probably did a little while ago, certainly as a society, as a species. And then we've done a really good job at limiting supply of critical things, whether it's childcare or housing, right? If you're a renter today, you're basically paying a premium. I would like you to kind of explain that. You're paying a premium because we have limited supply of that particular critical infrastructure. As an economist, nothing you said, whether it's left, right, center, or sideways, nothing was shocking. It just kind of spelled out the things we know that happen when we hard code values and then the world changes on us.
I think that's right. And I mean, the expression sometimes is used, you said the quiet part out loud. What I would argue is very few other people, and I've been very fortunate in building an audience and having people pay attention to my stuff. And I do think that there's an element of that as a precursor to going viral on something like that. People have to trust what you're telling them. But, have never had anything go viral in this fashion before. But there's just an element of, no, this was true, right? And we know this is true. And then you run into exactly what you described, which is, you step on political tripwires. And the thing that's interesting about this experience is it hits both sides of the equation, because it hits the left, who are understandably concerned that focusing on those who are what I describe as the precarity line, that feeling of barely holding on, where you're holding on by your fingernails, right? You're dangling from a building. The fireman says, "Are you okay?" And you look over and you see a person who's only got one hand holding on, et cetera. And you're like, yeah, I'm okay. Take care of them first, but I need some help too. Right? That's precarity. That's that feeling. If you focus people on that, like, well, does the fireman then ignore the person who's hanging on by one hand and really about to fall? That's the concern on the left, I think, quite legitimately, is are we going to distract from the needs of the truly designated poor, which are substantive and important? On the right, it was much less principled in its opposition. It took on much more of the characteristic of let's try to mock this and pretend it's wrong and push it away, because candidly, they don't want to encourage. It's a caricature, right? And the reason that they do that is because they do not want to reintroduce discussions around the decline in the progressivity of our tax code. Our tax code progressivity has collapsed in the last 50 years. It is radically less progressive than it was 50 years ago. And that actually has very important implications for thinking about how to model and play out the game of capitalism and the necessary redistribution that is required to prevent people who struggle and have a failed outcome against a single experiment, right? We call those things like bankruptcy, et cetera. And also, candidly, those born into the system without endowment, we call those children, right? They require resources to be made available to them to allow them to become functional human beings. We've forgotten that. We've forgotten that there is a degree of redistribution that is required to create those resources for the next generation of workers, participants, et cetera. And importantly, their parents who are making a financial sacrifice to have children. Yes, there's an emotional and sociological reward to becoming a parent. But if we make the financial burden so great, we're going to experience exactly what we've been experiencing over the last 50 years, which is collapsing fertility across the developed world and increasingly across the developing world. And so, unfortunately, my work really basically reintroduced this idea of, well, we got to pay attention to the center, not just the far left or of the distribution, right, which is what the more liberal leftist components are concerned about. And we also need to raise that level of redistribution in order to effectively provision resources for that next generation, which the right is, I would argue, very cynically opposed to.
Yeah, it lacks, one, obviously empathy, but also just logic. Look, we're an extraordinarily talented and wealthy country, and we have the skill set to deal with things like disruption. Hey, technology is going to take your job away. Hey, this new economic system called globalization is going to take your job away. Here is the pathway to taking care of you through that valley of pain. Or, the existing players, we've done a reasonably bad job of saying, hey, we're doing this for the greater good, whether or not that's good for you. Well, we can have a conversation about it, but we'll sort it out so that you don't fall through the cracks. And that's for the existing players. That's for the coal miner who's out of a job or the factory worker who's out of a job. And then you've got the kids who are falling behind, hungry, or just living under a lot of stress because the parents are not technically poor, but they're just really living life to make it happen. And it is my suspicion that if we did the national accounting a little more completely, a very large fraction of our national wealth is human capital. It's people. It's not just the financial capital. And we're kind of setting ourselves up for bad outcomes. I really encourage everybody to engage with your writing. It's absolutely fabulous, whether it's kind of more narrowly on markets or on some of these social and societal issues. I repeat, whether you and I agree or disagree on certain things, I really think of you as an honest thinker, someone who's trying to pursue truth, whatever that means, in real time. And that's all we can ask of someone who's sharing their thoughts for the public to consume. On the way out, I have a quick fire set of questions that I inherited from my youth. As you know, I was born and raised in Paris. The French being the cultural, metaphysical people that they are, I used to watch a TV show hosted by Bernard Pivot on basically new books and new cultural things, plays and whatnot. And at the end of every episode, he asked his guest a series of questions. The same series of questions was adapted into American TV by James Lipton for Inside the Actors Studio. So if you recognize the questions, you may not have been watching French TV. You might have just been watching James Lipton. Are you ready for a quick fire set of questions?
I'm as ready as I'm ever going to be. I'm just glad that they're going to be delivered in English instead of en français.
By the way, you can take them as literally or be as interpretive as you need. Okay.
Okay.
What is your favorite word?
Oh, man, probably dynamic.
What is your least favorite word?
I can't. It's a phrase.
I get it. What is your favorite drug?
Probably alcohol or caffeine. Those are the two that are regularly involved.
What sound or noise do you love?
This is actually really funny. I talk with my wife about this all the time. As I get older, I love, really good music delivered in an intimate setting, live performances, etc. What I can't stand, and it's probably the old man in me coming out, I can't stand the background noise as that elevates. So I hate going to a large concert. I love going to a small, intimate performance.
Got it. Well, you answered the next question, which is what sound or noise do you hate?
I figured it was coming, yeah.
What is your favorite curse word?
It's going to be the F-bomb.
That's fair. Who would you like to see on a new banknote?
Truman.
Tell me more.
I think that Truman is among the most underappreciated presidents, both for his decency and for his steadfastness in prosecuting the remainder of World War II, recognizing the importance of the sacrifices that were made by the young men and women that served and working incredibly hard to make sure that they came back to a productive economy that recognized those sacrifices.
Yeah, I agree. What profession other than your own would you never, ever want to attempt?
Well, I often joke about this, but I'm not cut out for underwater basket weaving.
If you're reincarnated as a plant or an animal, what would it be?
Probably a hawk. Just the freedom to be able to float above and observe the world would be a really magnificent gift.
All right, last one. Are you ready?
Yeah.
If heaven exists, what would you like to hear God say when you arrive at the pearly gates?
I would hope welcome.
Well, Mike Green, this was a fantastic conversation. I so appreciate the time we spent together today.
Thank you, Jonathan. I really appreciate it as well.
This podcast is for entertainment and education only. Nothing here is financial advice. Treussard Capital Management is a registered investment advisor. Please visit our website, treussard.com, for additional information and disclaimers.